it's almost exclusively a function of the Fed and expectations that they're going to slow the pace of rate hikes. For sure, I think earnings season is progressing well, and I've been in the camp all along that when we have inflationary recessions where real GDP growth contracts but nominal continues to expand, like 1970, 73, 75, 80, or 81, 82, earnings downside is much smaller than it would be in a credit type crunch like the Great Recession or even 90 when the commercial real estate market collapsed. But this is really about the Fed, and it began with instability that began after the last FOMC meeting. The Bank of Japan intervened to the tune of $21 billion the subsequent morning. We've seen extreme weakness in Europe. And listen, this is something I think you could appreciate in particular, Brian, with all your great work on energy. The dollar has become a petrocurrency. For almost 5 decades, when energy prices were strong and there were shortages in energy prices, the dollar went down. That happened in the 70s and in the O's, whereas in the other decades when energy was more abundant, the dollar was strong. That's no longer the case. So we're actually making the situation much worse in Europe, much worse in Japan, the situation being the energy crisis, by tightening as aggressively as we are. And I think Lael Brainerd was the first one to pick up on this. She's the start of the dovish, developing dissenters. Well, and it's now translated out to Daley and Evans, George for other reasons. But there's a constituency that wants to slow the pace.
Well, listen, there was a great note out by Data Trek Research. By the way, I made it my RBI on WEX tomorrow morning, which is this is one of the most volatile periods in the last 20 years for the stock market in terms of more than 1% moves over a given number of days, right? We had a great early spring rally. Then summer was absolutely terrible. Now we're rallying again. It's been highly volatile. And what their point was there, Nick Colas and them doing some great work, was that will not stop until the Fed stops. Sounds like you would agree with that until and I'm so sick of talking about the Fed, Barry, every day, right? But we have to.
Yeah, when you look at the correlation across asset classes, walk in every morning and look at what the dollar's doing. If it's up, so are bond yields, stocks are down, commodities are down. That correlation is so intense, and it's all because of the Fed. And it's how the Fed impacts monetary policy around the rest of the world. So, this hasn't been about inflation for a number of months. We saw inflation break-evens, expectations of inflation collapse in September. It's been about the Fed's reaction function to inflation. So the markets have been screaming, particularly the belly of Treasury curves globally, that it's time for the Fed to start taking a look around and slowing the process and easing back.